Hey everyone, welcome back. This is going to be webinar number 4. So, very interesting week, and we'll probably look at some of the examples with imbalance. So, we are now up to webinar number 4 for SMCs. Let me know if our audio is coming through okay, but I'm just assuming that everything is alright, but let me know if there's any issues. So, we're going to go through with imbalance. And I like to talk about imbalance because this is a concept that's a little bit unique, and it might prove to be some of those hidden support or resistance in the market. All right, so let's get this started. We're going to be talking about imbalances tonight. My name is Vera in general. Let's get this started with a quick disclaimer. Any opinion discussed in this webinar or linked to this presentation is provided as a general market commentary and does not constitute investment advice. News trading involves risk due to high volatility. Market reaction to news can be swift and unpredictable, which leads to higher trading risk and delays in order execution. So be attentive when determining the volume of your transactions and consider all possible risk factors. All right. A little bit about myself. You guys are probably bored by this by now. My name is Vera Injaro. I've been a full-time trader with over 20 years of experience, extensive experience as a senior technical analyst as well as chief technical strategist for Asia Pacifics with several top FX brokerages. Also served as a trading coach and technical analyst since 2007, assisting traders in their journey. Me personally, I use Ichimoku Kinko Hyo techniques. We actually did create several webinars on Ichimoku Kinko Hyo. It might get buried with all the videos out there, but there should be a playlist about it if you guys are interested. And I'm also a director of Zenefix, an independent market consulting company. I've been invited as guest speaker at prestigious events, including the Trading Investment Expo, Invest Fair in Singapore, ATA, as well as APTA conferences, which is the Australian Technical Analysts Association and Australian Professional Technical Analysts. But yeah, I've also been invited on several news outlets like Bloomberg, CNBC, BBC, and Channel News Asia for my market commentaries. Okay, so we'll take a look at a little bit of a recap on what we have gone through so far. I see there's already a few questions there. I'm actually answer those questions before we continue talking about market imbalances, because I need you to be on the same page with me, and we need to cover a lot of stuff as well. All right, so we'll take a look at understanding market imbalance. We'll take a look at fair value gap. There's also volume imbalance, and then we have the traditional gap as well, but we'll go through all of that stuff in a minute. Okay, so let's start with a quick recap of smart money concepts. So we're going to be focusing on the foundational role in understanding market dynamics, and then once we get that on the same page, then we'll highlight how these concepts underpin the identification and application of market imbalances and fair value gaps. Really want to focus on the fair value gaps because I think it's a very interesting concept, the way we look at gaps. Never thought about it that way to a certain degree. When we look at the market in a traditional way, we kind of go for the gaps. I think the adjustments made in the Forex market or the futures market, that kind of produces the fair value gaps in theory. Okay, so our objectives here tonight, not to not only define and recognize imbalances and fair value gaps, but also to develop actionable trading strategies based on this phenomena. Okay, so I'll pause here for a little bit and we'll go through the charts. So what have we covered so far? We have covered the identification of a swing high, a swing low, and then we are familiar with the break of structure, the change of character that happens in the market. A lot of this stuff are in there. This could actually be a change of character as well. So depending on how you look at it, but yeah. Then we also take a look at liquidities. We took a look at order blocks, and I think there's already a question about order blocks. What's the difference between just a traditional supply and demand zone as well as order blocks? I'll explain that in a minute. And I think there's already a question about retracement. When does it end? When does it start? Because it does play a big role in terms of identification that you're looking at, whether or not it's actually going to be a trend continuation. Is it just a retracement, or is it just or is it a major reversal? Okay, So everyone is clear about how to identify the swing highs and the swing lows. We need to identify that first. We'll probably use something else as an example first, and then we'll come back to the euro. Okay, so we'll probably take a look at. Oh, there's already something here on the pound USD. All right. Okay, so that's daily. That's fine. We can go on to the hourly time frame. So for now, on the hourly time frame, let's start with identifying the swing highs and the swing lows. So from what we see in the market here, what can we identify as a swing high and a swing low? If we have the information by now, I think it's pretty obvious that there are two levels that the market has not breached, and that would be our swing highs, and that would also be our swing lows. So the first one is up top. All right, always go for the highest level in the market and always identify that as a swing high. And if we just come into the market as it is right now, we can also identify this low here on the 30th of November as our swing low. So by theory, what we're looking at on the pound USD is that this is still constrained by the swing highs and the swing low. What about all the other stuff here? Can we shift the swing high to a lower point? You could if you want to, but I think the difference here, if we identify the latest one as a swing high, what we are looking at and how we identify this is that this is not that much of a difference. It's within a 10 pip range in the market. So I would go for the higher one. Okay, I'll always go for the higher one. Okay, now once we identify the swing highs, so I'm not going to label that as a swing high. We need to understand if there's actually a potential break of structure, or is there a change of character that happens in the market. Okay, there might be a few, because if you look at what's going on inside that range there are a couple of what we can identify as potential change of character as well as break of structure, but it will be on a smaller scale. It will have a different impact because we know we have the swings, and then we have the internal structure. We have the swing structure, internal structure, and then the fractal structure. Okay, so let's just assume, all right, we just look at the chart, we haven't labeled anything, and we want to start fresh in terms of how we label stuff. The first thing I always do is to identify the swing highs and the swing low. Now, take a look at where the resistance are being clustered up top. Is there going to be a potential order block or not? Now, in terms of how strong an order block is, or in terms of any resistances or support in the market, it's always best to just pinpoint where the psychological level is. Now, for the case of the pound USD, it is very clear that the psychological level is going to be at 1.27. Now, the question asked is that, all right, 1.27, but market did went above 1.27 and attempts a few things here and there, but we would label this as kind of where we want to zoom in and immediately identify a certain range. Is there actually an order block? Now, would there be an order block around 1.27 that we can identify from what we see here? To a certain degree, yes, this would actually be our order block. All right, and anything beyond that would be our limit to the liquidity, because it kind of stacks up. So I'm just going to label this for now as a bearish order block, which is at 1.27 up top, and above that between 1.27 and 1.2725, which is about this range, I'll label it as something else, and that's how we start building our resistance in the market. Okay, now this second one up top, we are going to label that as our buy side liquidity, which is our resistance. So in theory, the technical resistance that we have on the pound USD is actually about 40 pip of range. Those are going to be stacking up, and that's where we want to be really careful. And that's also possibly the reason why the pound USD hasn't progressed much higher, because if we go onto a higher time frame, there's a clear intent to actually sell at 1.27. This is probably not obvious on the hourly time frame, but once I start shifting onto a higher time frame, right? For example, this one here, this is on the 4-hourly time frame. You can see what's going on here. This is what we call a liquidity grab, which is over there. So we saw the market kind of sweeps it, and that's where we know there's actually going to be a liquidity grab as well. If we go on to the daily time frame, what we're looking at is candles barely managed to break or close above 1.27. The Friday close doesn't really count because it's just about 1 pips above 1.27. All right, so what we're looking at, obviously we can identify this. We don't need to have the knowledge that there are institutional interests, there are smart money interests in terms of accumulating positions to sell on the pound USD. And this is also something that I mentioned on the outlook this week. The intent to sell at 1.27, it's so clear, it's so obvious, it's kind of crazy. But if you have been watching the outlook that I published on Monday, I also put a note out that despite the intent to sell at 1.27, the pair itself has actually been finding support closer to 1.2625. So I'm going to go back onto the small time frame, and what we're looking at here on the 1.2625 level, you can highlight this level and actually turn that as our bullish order block. It might not be strong because technically it's actually not really strong at all, because we have our swing low here and price is actually still getting pressured. But whatever it is, it's still holding on the pound USD from collapsing any further. Okay, so that's how we look at it. If you think the hourly time frame is a little bit of a noise, always jump onto a time frame that's a little bit higher, and we can actually identify that level. And if we zoom in to that level, is there something exactly at 1.2625 that could potentially be holding the market down from going down? Yes, there is, because our psychological levels would be anything that ends with 00, 25, 50, 75, and goes on. Okay, so right now we have that order block at this point in time. It's probably irrelevant on the hourly time frame, but it's very relevant on the 4-hourly time frame as well as the daily time frame, because it's still holding the pound USD from sliding further. But I don't like using that on the hourly time frame because our order block technically comes down a lot closer to 1.26. Okay, so what can we identify from this bearish order blocks and whatnot? Take a look at at where market breaks back down below the bearish order block. It comes back, the market does come back and retest it before going down even further, and that's where it comes back to our swing low on the pound USD. So far so good, and we don't actually have a break of structure at this point in time. Now, pretty obvious when we say the intent to sell at 1.27 is strong, because during an accumulation phase, notice what the market is doing. It basically goes in a range bound market condition. Okay, so it's not actually trending, and when you see a market that doesn't trend, we are looking at a potential accumulation phase that is going on in the market. Now, obviously the buyers are still there. We still have that floor at 1.26, and for as long as 1.26 or this swing low is not broken, it's kind of a neutral scenario with the pound USD, because we can't just assume, all right, the intent to sell at 1.27 is so strong, we should just continue shorting it. If you want to short it, you would have exited at the swing low that we have here on the pound USD, which is closer to 1.26. So if we are looking at the pound USD, what can we identify? We could potentially be looking at a potential break of structure on the swing low here. If price dips down below the swing low, it could potentially create a little bit of a trend continuation to the downside, and this would shift into a break of structure. All right, but we're not looking at that as of yet, so we're still going to label this as a swing low. Okay, evening all. Okay, there is a question about a retracement, I believe. The difference between demand and supply zones and order block, I've already highlighted that, and the difference between the two of them is that supply and demand zone can appear anywhere, right? Anything can be a supply and demand zone. But when we take a look at order blocks, and I'll explain this tomorrow during our final webinar, if there's actually a trick to identify this order flows in the market. An order block is identifying a potential order flow in the market. It's more on where the big funds or the big traders are accumulating their positions. Those are going to be our order blocks. Supply and demand can come in different forms, and order blocks are just part of a supply and demand. So a supply and demand, it's really more of, I don't like to use the word supply and demand, I'll be honest with you. I still call it as a support or resistance area or a support or resistance zone. I know there are modern use of supply and demand, but it's so general, it doesn't actually mean anything at this point in time, because anything can be a supply and demand. Okay, so that's that with our recap. I think we've spent enough time on our recap, so I think we can move on. But to answer if there's actually going to be a retracement or is it going to be a reversal in the market, the assumption is that anything that goes beyond a 20% correction in the market will start a retracement. And those retracement can be categorized as a normal retracement range, which is a 38.2, 50%, 61.8% Fibonacci retracement. But you kind of need to have that knowledge about Fibonacci. If you don't have that knowledge about Fibonacci, obviously you can use other things like what we talk about with the premium and discount area on the market. Okay, so let me just highlight that again. So if we identified the swing high, we identified the swing low, we take a look at the rejection that happened around the buy side liquidity. Obviously this, we can identify that as a premium or discount. What we're trying to look at here is any range in the premium side closer to the swing high would actually be the optimum level to actually sell in the premium zone. And if it's in the discount zone, we are looking to buy, depending on the trend, obviously. But with the pound USD, obviously it's unique because we don't have a break of structure or change of character that's ongoing in the market on the much bigger swing. Technically speaking, we're still looking at that potential accumulation to sell in pound USD at about 1.27. So it's kind of stronger and a reason to buy above at 1.27. Does that mean if you're thinking, all right, this is closer to the swing low here, can I buy the swing low? Technically you can, but if you look at how this is currently being pressured, you actually have a higher chance of this one going against you because you're not really giving room in the market. But yeah, we'll talk more about premium and discount tomorrow once we have everything. Okay, everything good? We're on the same page? Okay. Let's talk about imbalances in the market. Now, a very good example here on the pound USD. Take a look at this area where it's actually finding a little bit of a resistance, and this can actually be identified as a potential order block as well, right? So we can actually identify this as a potential order block, but there's actually something there that makes it become a resistance in the market. Can we identify that as a potential order block? Yes, but does it fall in a specific key levels that we're looking at in the market? It doesn't fall into any psychological range, because when we take a look at the psychological level in the market, we're going to be looking at 1.2625. Just a little bit rough here, but bear with me here. 1.2650 and 1.2675, right? About there. Those are going to be our psychological levels. We already have the 1.26 over here. So we got 1, 2, 3, 4, 5, right? There's always going to be 5 psychological level in every 100 pips. Now, this doesn't fall anywhere in between. So technically, there's something here that's actually blocking the bearish order block. Okay, so we're going to continue into that because what we're looking at there is a little bit of an imbalance in the market. So when we try to understand a market imbalance refers to a situation where the buy and sell orders are not matched and often leading to a rapid price movement. Now, smart money traders often create or exploit these imbalances. Remember, the word there is actually create, okay, or exploit. Either they create that imbalance to their favor, or they are going to take a look at what they know and exploit these imbalances to enter or exit positions, thus driving the market. And the first one we want to talk about is going to be the fair value gap. And this is probably the easiest to identify and probably something that we're actually going to take a look at a lot tonight. But I want you to understand what a fair value gap is. So an FVG is a price range with no trade activity, signaling a gap between value and value perceptions in the market. It also means there are price inefficiencies because this gap often represents the area where price can rapidly move to fill in those gaps, creating a potential trade opportunities. Now, an FVG or a fair value gap, it's a 3-candle pattern that hides a gap between the first and third candles wick. Okay, I'll probably pause here before I move on to the rest in a minute, but I really want to focus a lot on the fair value gap. I might change the structure a little bit here for tonight, but the fair value gap is actually a very interesting concept. If you're wondering, okay, where do I get this fair value gap? Okay, the next chart, it's probably something that you can actually take a screenshot of. So a bullish fair value gap, the other name, which it's informative, but I don't think it actually means anything. But yeah, if you guys are wondering what it is, a bullish fair value gap, it also means a buy side imbalance or sell side inefficiency. So we're looking at an imbalance, there's inefficiency in the market. Okay, for a bearish fair value gap, we also call it CB. It's a sell side imbalance and a buy side inefficiency. So I don't really like to label it as a bullish or bearish fair value gap because it's kind of pretty obvious what it actually means. Okay, so I'm going to jump onto the chart and I'll zoom in a little bit and we'll try to figure out why is market being capped at about this level here. So to identify a fair value gap, take a look at these 3 candles that goes down. It goes down so rapidly, it actually creates a little bit of a gap where the first candle and the third candle never met. Okay, and that's what we try to identify as a fair value gap. Okay, let me just change that to something a little bit darker so you guys can see it. All right, how's that? All right, and I'll bring it to front. That gap there, you can see that gap there, that's a fair value gap. It's where price on 2 periods doesn't meet up. Okay, if it doesn't meet up, it will eventually get filled in, and that's kind of the logic in it. Now, where it fails halfway through, I'll explain this in a little bit once we identify our fair value gap. So we can actually draw our fair value gap. We're going to start to create a box from the low to the high, the limits on where price does not meet between the first and the third candle, and this is our fair value gap. Okay, so I'll just put FVG. Okay, we got that, and see where it's actually starting to fail, and the highest point on where that rejection is, where it created an order block, it's actually part of a fair value gap. And the reason why it actually just didn't stop at this particular level and it kind of extended a little bit up top, because in the middle of a fair value gap, I'll try my best. If I can measure it, I'll just measure it right now. It's about 15 pips. So I'm taking a look at a potential about 7.5 pips, yeah, in terms of range, or 8. About 7.5, yeah, about there. Just to give it a little bit of an average, and I'll actually create a horizontal line on it. It's a little bit lower than 7.5, maybe about there. Okay, I'll try to be as accurate as I can, but the point is the middle level on a fair value gap, it's something that we call, just write that down here. It's a consequent enroachment, okay, or a CE. You don't need this, I'll be honest with you, but I'm just being very technical on what that is. A CE is actually just the middle point of a fair value gap. The whole idea is that it kind of becomes the limit in terms of where the fair value gap is actually going to work as a potential supply or demand zone, right? As a potential resistance or a potential support. Now, if price continues to break beyond the consequent enrichment or CE, it will try to break beyond that fair value gap. And if it does happen, it will likely reverse the trend, and this is something we call as a inversion. Okay? So if an inversion does happen, the next thing that the market does is it will actually come back to the fair value gap itself and it bounces up. So this becomes a little bit more complex, right? So that's probably why I don't want to talk about imbalances in the market until we kind of understand the basic, where we can actually frame what's going on in the market and whatnot. Okay, so it's good to know if there's actually consequent enrichment or CE in the market, but let's just say it's just in the middle of the fair value gap. I don't like this naming convention. I don't even like the CBOBC, whatever. I just call it a fair value gap. It's very simple as that. And the logic behind the fair value gap is that it acts as a normal support and resistance. So if with any normal support and resistance, once a resistance is broken, the market tends to come back and retest that level. And that's basically what follows after an inversion, or basically a trend reversal. Okay, but let's just clear this off. I just want to highlight the reason why fair value gap is so important, because you might think that there's actually nothing in there that could actually cap the market from going higher. Instead, you could look at that as a potential order block, but if you add something else in there, you would potentially identify this as a fair value gap, and you would be more careful about buying in pound USD. And this is why the pressure is still there on the pound USD, because right now the status on the pound USD is that there's a fair value gap. The market has tested, it got rejected halfway through. The fair value gap is now a valid fair value gap. There's also a bearish order block at the top there, which is part of the fair value gap as well, and that's still capping the market from progressing any higher. So with that in mind, would this be considered a fair value gap? I'll just throw it out there. With this here, I'm going to change it to green. A little bit darker maybe, yeah? That green area there, is that a fair value gap? Do you think that's a fair value gap? For pound USD, why can't we count the candlesticks from upsides? No, can you explain that to me? What do you mean by counting it from upsides? I'll come back to the questions in a minute, but let me just ask you and throw it out there for you. Is that green box there a fair value gap? Because we're looking at a little bit of something that's different. No. Okay. No. No? Good. Why is that? Why is that not an imbalance in the market? Why is that not a fair value gap? Because, you know, this is easily mistaken. If someone's learning about fair value gap, a lot of you guys are probably going to be looking at that and saying, yeah, could that be a fair value gap? Is there a fair value gap there? It was also imbalanced at 1.2685, 1.2705, 1.2685, 1.2705. Well, there's a lot of imbalances in the market, because there's actually one over here where we can actually identify as a fair value gap as well. There's actually a lot of fair value gaps on the way down. So we're looking at a pound USD that's actually being pressured to the downside. Liquidity pool, no. The third candle meets the first candle, yes. The third candle meets the first candle, and in fact the third candle is still part of the first candle. So let me just control and highlight that. This area still meets, and therefore this is not a fair value gap. Okay, so from here, can we identify a lot of fair value gaps? Let me just go through the questions here. How many times can order block be mitigated? You mean how many times market can come back to that order block? As many times as it wants, until that order block is cleared or there's a clear rejections. What about imbalance fair value gap between 1.2650 and 1.2670, which is this one here, right? Will it be filled before price dumping far away, or price no need to respect that imbalance? It doesn't have to respect that imbalance, because the way we look at it, this is scaled down, right? It will try to clear the latest or the newest imbalances in the market, because if we assume that everything needs to be cleared out, then the trend wouldn't progress any further, just by logic, right? If the market keeps going back and filling in the gap just to equalize everything, then the trend wouldn't continue. There are going to be differences, and this is why it's called fair value gap. The reason why it's called fair value gap, it's an assumption, right? It's an assumption that there's actually a little bit of an imbalance in the market, all right? We can identify a lot of fair value gaps, but we'll always use the latest fair value gap. And if that fair value gap is corroborated with something else, like an order block, then we'll take that as a stronger resistance. So the fair value gap itself, it's actually not a perfect imbalance to a certain degree, because it only skips one candle in between, right? But by nature, those candles are still connected by the second candle. Okay, the first candle and third candle is somehow still connected by the second candle. So in terms of price filling in the gap, it is actually filled, but it's probably not 100%. Okay, a normal gap where there's actually space in the market, that's probably more important. That's probably something that needs to be filled. Okay, cool. Are we good with fair value gap? We can go on and continue looking for fair value gaps, but right now there are two identified here, and the one here, which is the latest one, is probably more important as a fair value gap. Now up top, is there a fair value gap between this candle and that candle? Logically, yes. And to take a look at those two, I'll just change the larger fair value gap, right, which is part of a bullish fair value gap, I'll be honest with you, because it ranges up and it becomes part of it. What's interesting here is that the two bearish fair value gap actually still overlaps with the large one. So obviously the large one is probably more important. Now, what's very interesting here, something that I just explained happened in this example here, and this is why I like I like it when the market comes in and give you all this example in a live session. I don't actually have to go back and look at stuff. When it breaks below that fair value gap, let me just clear off the bearish fair value gap first, because we want to look at it from two perspectives, right? Because it's a ranging market. Let's just be honest with ourselves. All right. So I'll clear that out. There is an inversion because price breaks below that fair value gap. What's interesting with an inversion is that it will attempt to come back and correct itself and try to come back as close as possible to the original fair value gap. And the reason why it doesn't need to go all the way in there to the CE level or the enrichment level is because we've established two new fair value gaps, which is here. Was it there? No, sorry. Here. Yeah, sorry. Here. See? No, that's actually not a fair value gap. It's actually this one here. Yeah. That one and the other one, it's actually here, right? So let's highlight that. We have two fair value gap that we can actually use, and that kind of gives us another reason that it doesn't need to reach the CE level, right? It doesn't have to come back to the middle of the fair value gap. So I don't want you to be static when we take a look at fair value gap. I want you to be able to adapt now, because if I don't mention this and buy the book fair value gap, a lot of traders are probably going to assume that, oh yeah, price needs to come back to that particular level. It would be ideal if it comes back to that particular level, but it doesn't have to, okay? Because if there are resistances that's building up before it can actually get there, then there are actually higher chance that price might not actually come back to this area as well. So we'll try and use the latest fair value gap. I will leave this one here just as a backup, meaning if it does break above 1.2650 level, which is a psychological price level, there could be a possibility it might actually come back to that fair value gap. Okay. If the price retraces more than 50%, can it still be identified as correction or potential accumulation in the current market conditions? It would still be identified as a correction. Anything beyond 78.6% is where we identify as a potential trend continuation. It doesn't apply to accumulation because accumulation can happen within a range, right? So a lot of traders thought if we take a look at the accumulation that happened in the pound USD, it all falls at 1.27. Now, I'll be frank, and I'll open it up to you. 1 cent means nothing. 100 pips means nothing to the institutionals. What the institutionals look at, while we're here looking at the small things and whatnot, the institutionals looks at 1.26 to 1.27, that whole block there as a potential place where they might be accumulating their positions. Okay? So I'll just be honest with you. So anything between that level would be your accumulation. So anything in a range-bound market condition would still be categorized as potential accumulation in the market. Okay. So yeah, the retracement level doesn't mean anything in terms of whether it's still accumulating positions or not. Do we need to consider candlesticks with a wick as a fair value gap, or it doesn't have to necessarily have a wick to be considered a fair value gap? No, it doesn't have to have a wick. Typically, it will have a wick, but if it doesn't have a wick, I actually have an example, but I'll probably need to come back to. I'll try and pick this out. It's definitely on the pound USD on the weekly. I'll try my best, but here we go. Okay, where is it? So it's this one here. It does still have a wick. There's an example where it actually doesn't have a wick. Okay, but we'll move on. We'll come back to this example here in a little bit because there's actually a good one that I can show you here. I can't clear this off, but we'll probably pull a new chart. I'm trying to kind of figure out what chart I can use here. I'll probably use this one, but we'll come back to weekly on the pound USD and explain a few things. Okay. So far, so good on the fair value gaps. We can do a lot more exercises. Right? Let's go on to the Euro USD. Is there a fair value gap here on the Euro USD? That's really obvious because if you can kind of point out something that's really obvious as a fair value gap, it becomes really apparent when you can actually understand the fair value gaps in the market, right? All right, so let's take a look at this one here. Immediately, you can take a look at this one here. So the question to answer that, does it have to be a wick or can it just be a full candle? It can be a full candle. As long as the first candle and the third candle didn't meet, it would be identified as a fair value gap. Okay, the rejection happens midway point at the CE level, which is fine. But obviously, if we go dig deeper into the Euro USD, we know that there's something there on the Euro USD because on the daily time frame on the Euro USD, we're still within that range on the lower end. That would be at 1.0850 that we just broke today. Okay, but there's a fair value gap. And if you cut down the middle, it's actually very close to 1.0850. So the point of rejection comes very close to 1.0850. So from there, we'll just adjust it to halfway point, which is the CE level. And that's probably where we're looking at the rejection in the market. So I don't really like to use the CE level. Anything that goes into the fair value gap, to me, it becomes an active resistance or an active support. Now, if we take a look at the run up here, is there a fair value gap in the market? There's actually a small fair value gap here, which is probably more of a bullish fair value gap, and it becomes something in the future as well. I'll just change this into a blue color, right? So the darker one, it's going to be a bearish one. The bullish one is a fair value gap that we can identify just from here, okay? In the future, it does become a point of contest as well for the market, but yeah. I don't like that because it's so small. If we take a look at this one here, how big is this? You know, how is it relevant? Because if we take a look at the size, it's only 4 pips, so it's probably irrelevant. So be considerate, okay? Don't just take anything as a fair value gap. Even like this one here, it looks big. It's only 10 pips, but it's enough to create a little bit of an invisible barrier. But this is the reason why I don't like to use just a fair value gap. It's still much better if you can identify a potential order block in the market, or is there a psychological price level in the market. You know, that would actually be much more meaningful than what it is. So right now, as the market goes down, I know the candle hasn't closed, but in 20 minutes time, if price doesn't come back and fill in, there's actually going to be a new fair value gap. We still don't have that information as it is. And in terms of whether or not there's actually a break of structure, we don't have a break of structure because we can still identify this swing low here that's still capping the market. So we still identify that as a potential swing low. However, if we take a look at this one here, what's interesting, if I were to draw this, it would come in somewhere in between. I just need to make a little bit of an adjustment. It will be at 1.0825, which is a psychological price level. That level, it's very close to the consequent enroachment, or the CE level in the FVG. So by right, if I were to go onto a smaller time frame, I would look at this as a potential point where market could come back to 1.0825. If it fails and doesn't exceed the fair value gap that we have on the hourly time frame, even though it's small, there is a potential for this to become a rejection in the market, and we could actually see more of a trend continuation. We might even have a potentially new break of structure in the Euro USD, and that's how we kind of compile everything. Probably tomorrow we'll take a look at more of these examples where we add on stuff and then we try to kind of frame the market where it actually wants to go. Okay, but is that fair value gap noticeable on the 15-minute time frame as well? Yes, it does. It still exists there on the 15-minute time frame, and it becomes closer to the upper range at about 1.0825. So fair value gap is everywhere, and it's always good to just label the fair value gap, because take a look at this. I can build up a lot of reason why there's going to be a potential resistance at 1.0825. There's a fair value gap here, which is considered to be a bearish fair value gap. And there's actually a fair value gap on the way up there that kind of overlaps with this level here. So the more boxes that I have and the more overlaps that I have, you can actually identify those zones as potential resistance. So we can identify within the fair value gaps where it kind of overlaps. You can identify a little bit more of a stronger resistance in the market. Take a look at where it's actually failing right now. It's at the darker zone on the overlapping fair value gaps. So the logic is sound and simple. It's just that when this is taught to a lot of traders by concept, typically a lot of them just identify one fair value gap. I know it's probably less confusing, but it's also misleading to a certain degree. So just want to be clear on this one here. All right. I learned something new. A lot of you guys probably learned something new here on how to actually use the fair value gaps. Hopefully I gave you a little bit of a good illustration here on the fair value gaps here. Okay. All right. So let's move on, because we're still not done yet. We still have volume imbalance. So volume imbalance, it happens when there's actually a gap between open and close of adjacent candles with overlapping candle wicks. It's kind of like fair value gap, but you'll notice that there's still going to be a little bit of an overlap. So I'll go to the pound USD and give you the example here on the weekly time frame. Where is that? Is it this one here? The drop, the 3 drops? Yeah. Okay. So let's take a look at volume imbalances in the market. I think the closer one would actually be here. So let me zoom in, and I'll probably get rid of the grid here. Let me just get rid of the grid. All right, there we go. So you see a lot of spikes here. Right, this candle itself in the middle is actually very unique because this one, if you take a look at the body, it doesn't overlap with any of the bodies out there. that singular stuff there created a volume imbalance that we can actually see in the market. The candles doesn't actually overlap with the body itself, so it's just the wick. So this is probably where this is going to start being a little bit unique, right? This is what we call the volume imbalance, or the VI. It's where the body doesn't meet, but the wicks meet. So it's not really a fair value gap, right? To a certain degree, those two candles actually still meet. It's just that the body never meets, and it still becomes a little bit of an imbalance in the market. This is probably going to be a little bit rare, but if you see a volume imbalance, you need to be a little bit more careful, because this is no indication that anything is becoming bearish or bullish. A volume imbalance means that there's an unclear status in the market. It's because this one here create a volume imbalance as well. So this is actually a very unique scenario, right? So we're still connected. To a certain degree, we're still connected. And if you think that it feels like a fair value gap, but somehow there's no gap or anything like that, it could be a volume imbalance. This is part of an imbalance in the market. Does it mean anything significant at all? It's probably not something strong, right? Because with a volume imbalance, the difference is with a fair value gap, when the market kind of reverses on itself, it created an inversion, right? If it breaks through that gap there. With a volume imbalance, we kind of discounts inversion. We don't have consequent enroachment as well. So this is a much simpler gap in the market, right? By theory, it's something unique. You will come across this volume imbalance, but it might be very rare that it happens. Typically with volume imbalances, it just created a little bit of a ripple in the market, but it doesn't change the potential direction that it has in the market, right? If we see this, still picking up on the daily time frame, and let's see where the volume imbalances are located. All right, there we go. So I'm just jumping in onto the daily time frame. The daily time frame doesn't actually show you that volume imbalance. So, but on the weekly, it does create a little bit of a volume imbalance. So this area here where it created a little bit of a volume imbalance, always go into a time frame smaller than that, and you potentially be identifying a potential break of structure or change of character in the markets. Just keep that in mind if you're looking at a volume imbalance. How to know when there's a high or low that's broken? On pound weekly, it's not a gap. This one here, it's a volume imbalance. When it opens, it probably is a gap, but you can tell it's not a gap, right? So it's one of those unique stuff, because it gaps up, but somehow the volume gets filled, and then it gaps up again, but then volume gets filled again by the wick. If I remove that, you'll see the wick there. It fills in that empty space. So technically, it's not a gap. If you want to see a gap, I'll probably move on to an equity market to show you a gap. How to know when there's a high or low that is broken? Okay. Anything that goes beyond the swing low, like this one here, we'll know that it becomes broken. When we identify something that's actually broken, I need to go back to the initial time frame, obviously, which is on the early time frame. And let's try this. No, I'm not drawing it right. Okay, maybe something like this, yeah. Okay, when there's a close below that swing low, which is over here, that's when it becomes officially broken, and this swing low would then become a break of structure. So we're going back to number one. If you're not clear on this one here, go back to webinar number 1, which started last week. So this is why we're doing it consequently. If you're not following it through, it's always best to just recap. It's okay if you're here, but if you're still thinking like you're lacking the basic here, then go back to webinar number 1. Okay? Okay. I was late and don't understand how to spot a fair value gap. Is the webinar recorded? Yes, and I can show you here on the Euro USD on where that fair value gap is. So I'll get rid of this one here. So when you see this, it's okay if you don't understand. Just stop me, and we'll go through. We are actually going through a lot of stuff here. But yeah, if you see that gap between the first and the third candle, and the wick doesn't come, or first candle and third candle doesn't meet one another, that's our fair value gap, and that's where you can actually draw the rectangle from the low to the high. Just fill in that gap there. This becomes a fair value gap. Okay, simple as that. Okay, cool. All right, let's go on to the last imbalance that we want to talk about today, and this is where we can tell the difference between a volume imbalance and a gap. Space between candle highs and low with no trading activity, zero trading activity in between. That becomes the gap that you saw there. And this is obviously from an equity market where I can actually show you a lot of volume imbalances. As I say, volume imbalances, it's like a gap, but it's not a gap. It's also not a fair value gap. So that's where we identify that as VI, or volume imbalance. But the actual gap itself is that when there's two candles that never meet one another, and you'll actually see this a lot every Monday, because there's actually the weekend that happens. The market could jump up and down, and it'll create a gap. Okay, so with the logic on gap trading, which is probably something we're going to talk about tomorrow, where we actually focus on a lot more on how to actually trade using all the information that we have learning from all these 4 webinars tomorrow. The gap logic is this: when there's an imbalance in the market, the logic is that the market will somehow attempt to correct that imbalance. And this is the reason why we're talking about imbalances in the market. It's a very simple concept, but there are different ways to look at all these imbalances, right? To me, the fair value gap is a unique take on a traditional gap. Traditionally, when we look at the market, the understanding of a gap, we know there's actually imbalance in the market. We know there are actually trading activities, there are orders that didn't match up. So imbalance, to me, it can be explained as orders that never match up. What do I mean by that? If there's a buy order at one level and then there's a sell order at one level, the buyers and sellers never meet. That's basically what imbalance is in the market. So what the imbalance create is kind of an illusion. I would use the word illusion because it dives deep into our psyche. It affects our psychology, and when it comes to trading, because we look at an empty space in between, and we know it's not right. Everything has to be filled in, right? So it becomes a trading psychology. The longer that gap stays there, a lot more traders are going to be looking at that and say, you know what? But that gap hasn't been filled. It needs to come back and fill in that gap and stuff like that. And this is the gap that we're talking about. When there's actually no trading activity, it created a perfect imbalance in the market where the buyers and sellers actually never meet. That's what we should be very afraid of. So the fair value gap doesn't have the same logic as the traditional gap that you're looking at here, which is that pink block in the market. Can we define that pink block? I can right now explain this on gold. Remember that gold rally at the start of the conflict, right? I can go to daily. I believe that level is actually was it 1830? I'm just trying to identify that gaps, that the gap that we have on gold. There's actually a gap. I'm just not seeing it right now. There is a gap on gold about 1830, but I'm not sure if that's actually been filled. But anyway, if you want to see gaps, right, go to equity market. You'll see a lot of gaps. You can see that there are gaps here and there on the equity market. This one here, that's obviously a gap, right? Eventually it will get filled, right? So it works in the same logic as a potential inversion in the market. But yeah, we know when there's a gap, and the bigger that gap is, it becomes a much stronger pull to market. These gaps in the market, these are not gaps. These are just volume imbalances, right? You can see that there's a difference between volume imbalances and between a gap, right? This one here, would that be a gap or would that be a volume imbalance? That would actually be a gap that got filled just 2 days after that. So if you want to learn about gaps, I don't think it's actually wrong to go on to an equity chart and just learn about gaps and just look at the logic behind it. Okay. All right. So those are gaps. So yeah, we actually did take a look at the strategies of combining identification of imbalances and fair value gap with order blocks. We did that at the very beginning. As I said, I'm going to mix it up a little bit. Liquidity voids and other SMC indicators to form a coherent trading plan, like just we did on the Euro USD. We kind of stack up the fair value gaps and we take a look at a psychological price level, right? But yeah, we'll talk more about this tomorrow when we actually start setting up our trade. But just for the sake of this example here tonight, we are actually going to go back onto the Euro USD and I'll illustrate again how we stack up our resistances on the Euro USD. All right. But yeah, for this one, where's that block that we created there? I'm highlighting something, but it's not there. Was it the Euro USD that we identified on the 15-minute time frame? Yeah, I think. Okay, there we go. That's a fair value gap. It overlaps. It becomes a stronger resistance. For this one here, it builds up at about 1.0825. So we can actually identify a lot of stuff here. So for the Euro USD, if you're thinking of going short on the Euro USD, can we go short on the Euro USD just on the logic behind the fair value gap? Ideally, it's actually safer if the Euro USD breaks below that swing low and created a break of structure. It will become a stronger level. The fair value gap that we just draw on the Euro USD, it's not as an entry, because for this fair value gap to be an entry, we'd actually see price comes back into that fair value gap, and if it fails, we can sell. All right, so this fair value gap is where we actually want to create our limit orders. I want to create a short at about 1.0825 and potentially have a stop loss just beyond the fair value gap. I don't need to have my stop loss at that swing or anything above that, because that would create a lot of distance. I can just say, okay, I'll have my stop loss maybe 10 points above the fair value gap, and maybe the market will come back to test that swing low, but I'm anticipating that market will test the fair value gap and fails in between and potentially attempt to go to that swing low and potentially break structure there. Okay, that's how we actually use the fair value gap. Can this be combined with other knowledge, for example? Because I know you guys are probably thinking, oh, wouldn't that be like a retracement level and whatnot? In theory, yes. So let me just shift this a little bit. What we're looking at here with a fair value gap that's there, if I were to get rid of it and to show you the Fibonacci retracement, for example, that we have here. All right, that fair value gap would actually cut in the middle at about 50%. Does that imply something? Of course it does. It's at 1.0825. It's also a psychological price level. There could be a potential liquidity there that's kind of hidden in view. And in between that, that's also the CE or the consequent enroachment, which is the middle of the fair value gap. A lot of stuffs are, at that 1.0825. So if I were to trade this intraday and I would assume, okay, I haven't had a short position, maybe I can create a little bit of a short order just about that. I'll take advantage of the fair value gap and, expect the market to just fill into that fair value gap. But if the market goes straight down, I would cancel this order. Okay, that's how we would actually use the fair value gap. Simple as that. All right, XAU gap is only seen on the hourly and 4-hourly charts and below, 9th of October 2023. All right, thank you very much. Let's zoom in, because I really want to show you that gap there on gold, because until now it still is scary that we haven't filled in that gap. We're gonna go over time for a little bit, but let me just show you. Thanks, Tian, for the help. Really appreciate it because 9th of October was it? All right, 9th of October. Here we go. It's filled here. That's probably adjustment, but I know there's a gap here. That gap is pretty obvious. This is, I believe, this was the gap about 1830. That was actually a gap there, so it's not obvious here. But anyway, let's move on. So we did some practice. We did some trade example that we have on the Euro USD. I know we shifted out a little bit because I just feel like explaining it in a flow. Okay, but let's have a little bit of a Q&A. If you guys have any questions, we'll take a look at it. So isn't a gap on a pound weekly? No, so I was late. Yep, we filled that in. The 74.6 until 73.9 on XTI hourly does count as a fair value gap. XTI on the hourly time frame. Okay, hold on a second. 74.6 until 73.9. 74.6, 73.9, which is this one? Is it this one? Or is it this one? Both of them are fair value gaps, so it still applies. As long as price never meet, it would be considered fair value gaps. There's actually that point where it kind of overlaps and becomes a stronger resistance. Probably falls in right about 74.55, right in between. All right, SCS shopping market major trend was downtrend, was it? So what are you looking for? Do you want to become institutional for accumulation? The guy is behind, and yes, it has not been filled for about 3 weeks or so. No, it's in daily time frame on gold at 1840. Yeah, it was at 1840, 1830. I know that gap exists. If you guys saw it on your chart, you should be very careful about that level because that level has never been filled, and it becomes a concern for a lot of gold traders. Yeah, it's probably just contributor depending on the source there. But I know there was a gap there about 1830, 1840. 9th of October. You guys can go back into 9th of October. I know there's a gap there on the 9th of October. It's about 1830, 1840. Yeah, just about right on that one there. Okay. So oil, this is also a fair value gap, right? So there's a lot of fair value gap. There's a lot of imbalances in oil. This is why oil is a choppy market. Do we have a floor that we need to break? Obviously, yes. We have a swing low that we haven't break yet. So always label that, and we are closer to that swing low right now. Can it break and become break of structure on this one here? It could possibly be. But if there's a break of structure, the best way is let it happen because it might potentially pull back to the fair value gap and your order would still be at that fair value gap. It's just logical. Do you know why? Because if you shorted on that break of structure, your stop loss would be there and your potential target level would say be about 1-to-1 risk reward ratio, right? But if you have that knowledge about fair value gap, you could actually create a limit order up there. Your stop loss doesn't have to be that big, and your potential target is obviously a lot, right? You can just target 72, for example, which could potentially be an extension. It will still give you a much better risk reward ratio. So the point of having a fair value gap is that you really want to anticipate a potential return to the that particular level, and if that particular level doesn't line up with any psychological levels or any order blocks, that could be an invisible support and resistance area. That's kind of the logic behind fair value gap. If we have two fair value gaps that overlaps, it kind of adds up because it becomes very obvious where it overlaps. That's just why I don't label it as bullish or bearish fair value gap. To me, all fair value gap, it's about the same. I'm just looking at any overlaps with the fair value gap. It just makes sense that it becomes a stronger support and resistance level. If I establish support resistance level on the hourly time frame, is the level still valid if it's more than 1 week? Yes. But on the hourly time frame, it's actually going to be very rare because progressively as we go, right, it will the market will create a new range, because the market, by logic, it becomes a trending market. Most of the time it trends. So every time it trends, it will actually create a new range. So if we're not going to be looking at all those levels as very important. For example, here on the outlook, right? Market just comes back and forth between this range here, basically from December 2022 all the way now. There are actually only two that I highlighted, which is 1.0850, 1.09, and then the other one would be at 10650, 1.07. So not all level becomes a very important level. Just keep that in mind. Is it valid? Yes, of course it's valid. Like, for example, this one here, there's a little bit of a volume imbalance. Do you guys see that? There's a VI over there. In the future, does that mean something? Yeah, potentially it could be a future support area, but I wouldn't look at that as the reason why it would be a future support area. I would actually be looking at other things, right? Maybe I'll look at this one here. Oh, 1.0550. So that's something easier to remember. So the logic behind smart money concept is this. If you guys really want to know how the big funds are trading, they're not looking at crazy small numbers. So for example, here on the Euro USD, 1.0816, right? My resistance is going to be at 1.0835, which is a number that it's actually really hard to remember, because institutional orders will come in blocks. I'll explain this tomorrow. It'll actually become a lot clearer, okay? But I don't want you to think that because of this fair value gap, it happens at a weird number, it becomes something important. No. The logic behind the big funds is that they will remember a specific level. That number has to be easily remembered. It has to be very easily remembered. And this is the reason why psychological level works. And to a certain degree, why that psychological level works is because all these institutional traders, they are looking at that whole number. They're not going to be picking a random number in between. They are going to be looking at that whole number. So it's either going to be 50, 25, 75, 100. Simple as that. Okay? All right. So let's wrap it up for today. So we summarize everything. We talk about market imbalances, fair value gaps. How can that be integrated into your trading approach? Tomorrow is our final webinar. So I want you to be very prepared, because I want to share something tomorrow, and that would actually be identifying order flows. This is something that you are probably not going to find in other SMC or ICT webinars that's out there on YouTube and whatnot. Okay, so I'm going to show you something where we can actually start building our order flows, because no point learning about a smart money concept if you don't understand order flows, because the smart money looks at order flows in the market. A very simple logic, okay? And we'll also go through a full trading setup. Maybe we'll take one random chart. I'll throw it to you guys, because the way I look at this, the whole point with all these theories that we're looking at, it should be applicable to your trading. So I'll actually go in tomorrow. Be prepared. We'll do more like a semi-live trading session tomorrow, but I'll throw it up to you guys. What do you guys want to pick? We'll vote, all right? Whoever said the most thing, we'll probably look at that assets, okay? Okay, how do we confirm a reversal? A reversal if there's a change of character. So yeah, please go back to webinar number 1. We actually explained that. A change of character is actually webinar number 2. So think about it that way. All right, so let's wrap it up for tonight. Be prepared for tomorrow, because tomorrow is actually going to be very exciting. And I don't think I've actually ever explained order flows. For how many years I've been providing webinars with Octa here, I don't think I've ever actually discussed order flows in details. But I'll bring in order flows, and I'll show you a trick. How do you actually figure out that order flow without having access to the broker books, right? We don't know the order flows. If you don't have a terminal, which would cost you thousands of dollars, I'll actually show you a really quick neat trick. I've already discussed this before, but I never discussed it in a way that it should actually be used as an order flow. All right. Thank you all. Let's wrap it up for tonight, and have a great evening, great day ahead, and I'll see you tomorrow. Stay safe.